Welcome to The Explainer. Today, we're going to tackle one of the most powerful and, honestly, one of the most dangerous concepts in all of finance: terminal value.
So, let me just start with a question. What if I told you that for most companies, 3/4 of their entire value comes from a single, educated guess about the distant future? Sounds a little crazy, right? Well, in corporate finance, this is the reality they deal with every single day.
And that big guess? It's called terminal value. You see, after analysts build a super detailed forecast for the next 5 or 10 years, they have to figure out a way to account for, well, for everything after that, forever. Terminal value is the single number that's supposed to represent that entire infinite future.
Okay, let's dive into this.
Probably the best way to get your head around this is to picture a company's valuation as a giant iceberg.
All that super detailed work analysts do, projecting revenues, costs, cash flows year by year, the stuff they spend weeks, maybe even months building, that's just the tip of the iceberg. It's the part you can actually see, the part that's clear and above the water. The terminal value is everything else. It is the enormous, hidden mass that's lurking below the surface. It represents the company's value from year 6 or year 11, all the way out to perpetuity. It's huge. And that brings us to what I like to call the magnitude problem, because that hidden part of the iceberg, well, it's way, way bigger than most people think. And that creates a massive challenge for anyone trying to value a company. Get this. For a pretty standard 5-year forecast, the terminal value often accounts for a staggering 75% of the company's total value. Just let that sink in for a second. 3/4 of the entire valuation comes from the period you can't actually forecast in detail. This incredible size creates a danger that has a fancy name: sensitivity amplification risk. But it's really just a formal way of describing a simple and, frankly, kind of a scary idea. Because the terminal value is so dominant, it means that a tiny, tiny change to a key assumption, like, say, you nudge the long-term growth rate by just 0.5%, that can cause the final valuation to swing by 10, 15%, or even more. We're talking hundreds of millions or even billions of dollars hanging on a decimal point. So how on earth do analysts actually calculate this enormous future value? Well, there are really two main paths you can go down, two different schools of thought on how you put a number on forever. On one hand, you've got the perpetuity growth model. This is your pure, academic, theory-driven approach. On the other hand, you have the exit multiple method, which is much more of a practical, what's the market doing right now kind of approach.
And this table really lays out the core differences. The perpetuity growth model. It's all driven by an internal assumption you make about a company's constant future growth rate. But the exit multiple method, that's all driven by external market data. Basically, what are other similar companies selling for today?
Now, this heavy reliance on just a few key inputs creates this fascinating paradox. It's something that really trips up a lot of junior analysts. So you're probably thinking, okay, if 75% of the value comes from this one big guess at the end, why are we wasting all this time building a super detailed 5-year model? Right? Does all that painstaking work even matter? And the answer is, it matters more than anything. In fact, the rigor and the detail of that short-term forecast is what earns you the right to make a credible assumption about the long term. You have to show your work. You have to prove how the company gets from where it is today to that stable, mature, steady state before you can even think about applying some formula for forever. And those steady state assumptions, they have to follow real-world economic laws. For instance, your long-term growth rate, we call it G, it can't be higher than the growth rate of the entire economy forever. I mean, think about it. Otherwise, you're basically saying that this one company will eventually swallow the whole world. So it has to be constrained, usually somewhere between long-term inflation and GDP growth. Same goes for the discount rate. It has to reflect a stable company, not some high-flying startup. Okay, so given how powerful and sensitive these assumptions are, how do the pros stop them from just running wild and spitting out crazy, unrealistic valuations? Well, they use something absolutely crucial called a sanity check. And this is where the really sharp analysts separate themselves. They use both methods to check up on each other. So they'll start with the market-based approach, the exit multiple, and then they'll work backwards with a little bit of algebra to figure out what perpetual growth rate that market multiple is secretly implying. Then they see if that implied growth rate is even remotely realistic. Just look at this example right here. An 8x multiple implies a long-term growth rate of about 2.9%. Totally reasonable, that's within our economic limits. But look at the 12x multiple. That might be common in a hot market, but it implies 5% growth forever. That number breaks our economic rules. A good analyst sees that, recognizes that the 12x multiple is probably unsustainable, and rejects it. That's what keeps the valuation grounded in reality.
And all of this, the sensitivity, the assumptions, the sanity checks, it all leads us to the single most important lesson for anyone who ever has to do a financial valuation. Because these critical inputs are just educated guesses, best practice is to never present a single number, ever. Instead, professionals use what's called a sensitivity matrix, just like this one. It shows how the final answer changes as your key assumptions move up or down. You're not giving one answer, you're showing a range of possible, reasonable outcomes.
And that really is the ultimate lesson here. The goal of a professional valuation is not to find one single, magical, correct number. That's a fool's errand. It doesn't exist. The real goal is to build a credible, defensible argument for a range of values. It's about showing your work, stress testing your assumptions, and truly understanding the boundaries of what is reasonable. Because at the end of the day, a good valuation isn't just a number, it's an opinion. But it's an opinion that's been forged in rigor, logic, and a deep understanding of what drives value far, far into the future.